All right, good day, everybody. This is George Evans with Convergence, and I want to welcome you all to episode 25 of In Conversation with Convergence. This is something for some of you who follow us know that we meet with clients every month, obviously for a little over 2 years now, and we do talk about some of the top issues in the industry. This month, I'm thrilled. We have some really great guests from RSM today. And I'm going to let each of them introduce themselves, but I'll kind of try to do that briefly, right? So we're joined today by Jon Waterman, and Jon and I go way back. Actually, Jon was very early on in our podcast in its infancy, and probably that's what gave it the prominence it has today, Jon. But Jon is a partner and really is really the national asset management practice leader at RSM. We're also joined by Brian Lane, who's a senior director, and Brian's, I think, Brian, you're ex-CIT, if I remember, and if I have that right, you can correct me, but Brian is really focused on risk and really third-party risk management. And lastly, we're joined by Bill Andreoni, and Bill is a partner, one of the key, financial services leaders at RSM, and Bill's got some exciting news to talk a little bit about today, some of the new things that RSM is doing. So I'm sufficiently outnumbered today, but I want to thank all of you guys for joining me. So appreciate you guys all making the time today.
Certainly.
Why don't we start with just a little, you could do a much better job for our audience, just a little background on yourself and your role. And then, Jon, maybe we can start with you, and we'll go Brian and Bill.
Sounds good. Yeah, thanks, George. And thanks again for the opportunity to present and discuss. As you mentioned, I know we joined a couple years ago back when we didn't have the video on. And I'm obviously pleased to be here with the colleagues to talk a little bit about the business, talk a little bit about what we're seeing in the marketplace too. But as you kind of pointed out, I'm pleased to lead the firm's asset management practice. I also serve as an audit partner and also lead our financial services audit practice. And so helping clients, helping teams, just make sure we're taking care of the business that we see today. So Brian, I will hand it over to you.
Thanks. Brian Lane. I'm a senior director. I have over 35 years experience, actually most at Deloitte & Touche. I retired from there. My wife reminded me I'm way too young to retire. So I jumped at the opportunity to come to RSM about a year and a half ago. I'm going to talk about outsourcing a little bit later in the SEC rule on that. I've done quite a bit of work in that area. I led the launch of SOC 2 when I was at Deloitte, which is probably the most widely used report in the TPRM vendor management space. In between, I worked at Bank of New York Mellon and was part of a core group that started up the cybersecurity vendor management function there. I spent 3 years. And RSM, I'm one of our leaders of our national vendor management practice.
Well, thanks for joining us. Bill?
Sure. Thanks, George. And thanks again for the platform here. I'm definitely looking forward to the dialogue. So Bill Andreoni, I'm a partner in our consulting practice, more specifically our technical accounting consulting practice, which is an arm of our financial consulting practice. So I've been with the firm a little over 3 years. I actually joined right in the heart of COVID. So it's an interesting time to make a change in a firm, but it's a great transition. Certainly having a blast here. A big part of my role here is I lead the financial services industry for technical accounting consulting. Everything we do here, we say at RSM, we view things through the industry lens first. And by extension, also a co-lead of the new Fund Services Plus solution that we're going to be talking about here shortly. Over 20 years experience, everything from fund audit through fund administration at EY and Citco. Great to be here and look forward to the conversation.
Yeah, thank you. All right. Well, thank you all. Why don't we, Jon, let's start with, for our audience, a little overview of RSM, right? People know maybe the top 40 people. Everybody knows the big four, right? And, and I think you guys have really, been quite prominent in terms of role and growth and presence in the industry. I think so. In the last 5 or 10 years, I've just really seen you guys propel. But let's talk about RSM a little bit for our audience.
Yeah, thanks, George. And I think it's really neat. I've spent my career with RSM 27 years, and spending most of it in the financial services practice. So when I think about the firm, the RSM's been around about 100 years. We're really focused on the middle market, and that doesn't mean we're not catering to small entrepreneurs or big, billion-dollar fund groups that are out there. But the middle market is an airspace that we continue to be in, and we feel it's underserviced. And so we are pleased to be in that marketplace and practice day in and day out. From a financial services standpoint, we're going to probably touch 800 million in revenue this year at RSM, and of which asset management is half of that, 400 million. Mm-hmm. And so when I think about, where are we today and where are we looking at, we look at it within financial services is there's megatrends out there that we're trying to really arm our client servers with to be able to, be knowledgeable about, be able to talk with clients, be able to talk market participants. Those 5 megatrends that we've tweaked, but we update. One of them is Fintech as a movement. We see Fintech in the play that we see within asset management and other areas within financial services is certainly prevalent. And we'll talk a little bit later maybe about the banking industry and some challenges they're facing, but Fintech is certainly a disruptor in that. Regulatory and policy changes is another area that we're seeing from the megatrends that Brian's going to spend some time about. Governance and risk is an area that we all need to focus on and keep it front and point. The changing workforce dynamic is another megatrend, and obviously we've coming out of COVID and how people are hybrid, figuring that out. And then enterprise agility is the last megatrend that we're really focused on. But again, lots to cover. We won't cover it all today, but really appreciate the platform and what we can do in the marketplace. So
yeah, well, thanks. And if you're there 27 years, you started as a teenager then, huh? At RSM. Let's go to the 23 agenda. It's probably one of the busiest SEC agendas I've maybe ever seen in terms of rules and changes. And Brian, I'd like to chat with you and let you outline for our audience today really that agenda from your perspective, kind of that regulatory update, and take us through some of what you think, especially obviously the asset management industry kind of has to contend with this agenda.
Sure, George. Right now, the SEC has over 50 rules in process. Certainly a full agenda, even before the previous month, which is obviously going to drive some more activity. And the range of subjects is vast that are being covered. Right, the SEC has a broad remit from Congress, so there's a range of things there from societal issues like climate change, board diversity, down to things that are more mundane but important to us, things like how you name an investment fund. There's about 4 or 5 rules that directly are focused on asset management. Custody rule amendments, digital engagement practices. The SEC has sought input on that. 2 specifically would require the asset management industry, specifically registered investment advisors, to start up entirely new programs from scratch, not tweaks. One's a cybersecurity rule. Up to now, the SEC has not really required that, which is somewhat amazing. We got to this point. That one's been pulled back somewhat and reopened for comments.
Yeah, in fact, not to interrupt the flow, but Convergence just commented on that last week, right? We thought that needed some greater specificity, right, in terms of how they're going to measure it. So
it's broad, and it will require a lot of work, a lot of dollars, definitely. It was pulled back because the SEC released 3 other proposed rules impacting cybersecurity or privacy, updates to Reg SI, SP on privacy, and a cybersecurity one for markets in general. So very active, almost requires very periodic reviews of what the SEC is coming out with. We don't see it abating. We think that's one of the reasons, one of our drivers for what we're trying to do here. In our asset management practice, because we think the industry is definitely going to need some help with this full agenda that we don't see slimming down anytime soon.
Yeah. Brian, we'll start with you, but Bill or John, how prepared do you think the asset management industry is for, this kind of vast set of new rules, right?
I think that there are a lot of companies that are already trying to do the right thing now. I don't think anyone's saying, for example, like with outsourcing, that companies or organizations, RIAs, were not hiring vendors, service providers in an irresponsible way. No indication of that, well, even what the SEC has written. What is difficult is put the formality, the rigor, and the discipline around it in a way that would stand up to an examination.
Yeah. Yeah. And, we're seeing, we do a little work with third-party compliance companies also, right? And their agenda is probably as full as it's ever been in terms of some outsourced compliance, which I'm sure you guys are also doing. But that agenda for them has been somewhat educational for some asset managers. We've seen that, and we've actually seen it's been very eye-opening for emerging and startup asset managers. Some of the rigor, to your point, Brian, some of the rigor and discipline that you really have to have in place. I think with the advent of the CCO a number of years ago, we've seen as we examine all the filings for all of our data, probably no better culture of compliance, right? You're always going to have your outliers and your bad apples, but overall, we see amendments and changes and people understanding that what's material and that needs to be reported to the SEC. Not perfect yet, but probably better than I think it's been in a long time. So, all right. How about opportunities, guys? The world's filled with opportunities and challenges. So as you guys think about your asset management practice, right, and your financial services practice, what do you think the biggest opportunities and challenges are in 23 for you guys in this market?
I'll take that, George. Yeah, I think the biggest opportunity is continued support. I mean, our clients are struggling. I mentioned it a little bit earlier with the megatrends. One of them, that changing workforce dynamic, right? People are trying to figure out how they get done what they need to done within their back office, within their operations, maybe even, out front and center with investor relations, different ways to do it with fewer people, maybe people that aren't trained as well, and obviously leveraging technology. And so I think when we think about really probably the biggest thing out there is kind of that changing workforce dynamic and how clients accelerate their technological growth into the next generation so that they can get done more with less and certainly be confident that what they're producing is accurate and it's audible and they're not going to be subject to inspection if the SEC comes in. So
yeah. How on that issue, right? We've kind of seen really a very different look by people on outsourcing work because of that, right? Much more receptive, right, than they've ever been. You've had asset managers who are, for example, done everything themselves they could do, right, and also had that culture of whether it be fund administration in-house or whatever it is. But now we are seeing, and we're talking to Bill, right, and Lou Crasto about, lift outs, right? What some of these firms now that probably 5 years ago, you never would have thought they would have entertained that conversation because of the culture. And that culture is changing, right? Because, capacity and the war on talent. And, I don't know if it's as simple as shifting that problem to you, right? Or maybe you have a better way to solve it. But I think the workforce issue is, there's a new normal, right? Overused term, but there's a new normal in terms of how people are thinking about engaging service providers. So it's interesting times.
Yeah, George, I would say, and maybe I'll let Bill kind of chime in here a little bit, but we were recently, and I actually posted this on LinkedIn the other day, we were recognized, RSM was recognized as being the #1 service provider out there in the marketplace by Forbes, which is pretty neat to see.
Yeah.
Which is neat to see. Obviously, I haven't spent my career with RSM, and and understand the culture that we've got, really how we go about our business and really taking care of our people, our clients, being genuine in that. I think it rings true. And obviously, whether we, continue to grow different ways, I think there's ways we can go about it. I think we've had some success and we'll continue to do that. So Bill, you want to chime in too?
Absolutely. Just echo that point. Like, I think it's interesting when you sit in a lot of these dialogues, right? Whether you're in the proposal stage or the execution stage, everyone sort of says the same thing, right? We want to operate as an extension of your business, as an extension of your management, right? We want to be seamless. And I'm sure there's 16 other, keywords everyone says. What's paramount is that word that Jon said, which is culture, right? When it comes to engaging a provider or, an extension of your business, you have to be very careful that you're extending it to a culture that aligns, right? So whether that's how they invest in their people, right? The talent experience, the training, right? We talked about industry lens, just being overly functionalized and knowing how to do A, B, and C is no longer acceptable. In fact, a lot of that's getting automated. Right. Now it becomes you need to be more of a holistic provider, a holistic, view of the ecosystem, understand private equity in general, not just how I strike a NAV or how I do a capital call or how I do a white paper on a technical analysis. So I think the people component is always going to be important, but I think there's a renewed or a refreshed view on how important that culture is of the provider, not just what's on paper in terms of their capabilities, what they do, what they don't do. It's taking a deeper qualitative conversation with them and really understanding how are they going to be an extension of my business? How do they operate, right?
Yeah, and it's a good point because these cultures are changing at both the asset manager and the service provider. So they're kind of both moving targets. One of the things, we've seen, and it's probably a good segue, Bill, into, new fund administration business, but we have seen this much more than we've ever seen, this end-to-end approach, right? Where people, and I'm seeing it particularly in the fund administration world, where people want to bring as much product to the asset manager as they can. So we're involved in sourcing some deals for people from an M&A perspective, right? But so we've got fund administrators looking to buy, right? Managed services, cyber companies, third-party compliance companies, tax companies, right? And go right down the line. And they're saying, hey, we've got an asset manager who's needs 8 things and needs to make 8 decisions. We want them to make 1 or 2 decisions, right? And we have an administrator who, for example, client who's in Europe, and they've decided their foray in the U.S. is not going to be by an administrator. It's going to be to buy a third-party compliance firm, right? That's how they're going to get in, right? First, right? So it's really changing, right? And so listen, it's a good segue, Bill. I think this is really interesting that you guys have launched a new fund administrator, right? And in a world of 640 fund administrators, right? Some people might think you're crazy, right? But I think we should talk a little bit about what you're doing and why you're doing it, because I'm obviously privy to a little bit of it, and I think it makes a ton of sense what you guys are doing, given the kind of feedback you're getting from the marketplace and from your clients, right? So take our audience through what you guys are building.
Yeah, sure. Thanks, George. So, yeah, I think, fundamentally, we started where I think any logical conversation should start, which is we started with our clients. We had good, intelligent, detailed conversations. When we say with the market, it was a lot of our existing clients or clients we've served over the years. And we asked them, right? We said, what is your expectation today of both your consultants and your fund administrators? What's going well, what's not going well, and most importantly, what do you need future state, right? What are you not getting, or what are you getting that you really enjoy, or what are you not getting that you'd like? And there were a range of answers, but I think overwhelmingly there was 2 common denominators. One was we need a more holistic approach, right? Which hits on the point you mentioned, right? In terms of how the industry as a whole is reacting to this, whether it's focusing on the core competencies you've always had and saying, let's really capitalize on these, versus let's add these things on, right? More of a hub and spoke. So that's part of it. So putting that aside for a second, I think the talent piece was a big part of it, right? We talked about the extension of the business and, whether or not, there's cultural alignment and those types of things. So I mentioned the holistic approach. I think the other thing is, and it's always fundamentally been there, but I think it's been difficult to execute on, which is giving back time, right? So as an advisor, whether you're an emerging manager, an existing advisor, you say, what's of most value? My time, right? My time is of most value. And you're very prudent, you're very careful, you're very methodical in how you manage that time, not just yourself, but who you're willing to delegate to, who you're willing to consult. All right. So when we think about giving back time, I think the focus has always been on technology enablement. Let's bring the best technology. Let's do data analytics. Let's bring this dashboarding. And all those things are very, very fundamentally important. But often what gets overlooked is, well, when you break it down, like, where are you really spending your time? Like, if we looked over the course of audit season, if we looked over the course of the calendar year, tell us where you spend time. It was some of the simple things, right? It was, well, we're spending a lot of time in audit season, right? Every audit season comes around, it's been challenging. If you're not familiar with audit methodology, if you're not familiar with the audit process, if you've never maybe been in audit, there may be challenges to you navigating that audit season for your advisor, right? So audit's one example. There's a lot, right? Yeah. A PMO function, right? How many advisors, and John and Brian know this, how many advisors we talked to over the years where they said, I have 1, 2, 3 people, their only role is vendor management, right? That's what they do. And that's probably an underestimate. There's folks that have entire departments that do this. And they say, I have one role of PMO function. The third role is to make sure that this vendor is talking to this vendor, is talking to this vendor, and the data flow and this and that. Our solution was a simple one. We said, well, where are those areas, right? Well, tax is I'll call low-hanging fruit, right? When you have a tax provider and what I'll call a gap provider, data has to flow, communications have to flow. And you can make what's called an interfaced connection, right? Where it's not integrated, but it's interfaced. We set up controls, policy, procedures so that vendor A and vendor B are talking to each other. But the reality of it is nothing will ever supersede, nothing will ever be better than true integration, right? Having one firm that can do both the tax and the gap side. So connecting those types of things. So tax reporting. The last thing I'll mention is LP reporting. We all know that LPs strongly influence a lot of things, right? A lot of things that in terms of the operations, the investments, and it matters to them. So you have to cater to them. So you have to have an institutional grade, portal, an operating system, a technology, but a team that, again, as all these things get automated and they say, okay, I'm now able to repurpose my time. Well, what are you spending that time on? Are you just taking on more clients? Or are you reinvesting in that advisor? We view it as you should reinvest in that advisor, right? It's less about how many clients can I take on as I get more and more efficient. It's more about how do I repurpose my time to serve you, George, as my advisor. And that might be, institutional knowledge, advisory knowledge, industry knowledge, whatever it may be. And oh, by the way, agility that John mentioned earlier, right, is really important, not just a priority for us as a firm, but how we serve clients. We want you to benefit from that agility. I can get on the phone, I can talk to my valuation expert and then my due diligence expert as you're making your investment. And oh, by the way, here's our international tax consultant if you have a question around XYZ jurisdiction. That agility is everything. Yeah. So saving that time is what we're really focused on.
Yeah. So how, Bill, on the fund admin front, without giving away the secret sauce, right? But where in the market do you really think you're going to play well initially, or where are you focused for our audience?
Yeah, it's a great question. So I would break it down into, I'll call it industry first. So very, very focused on private equity. Again, as John mentioned, right, middle market private equity, that is one of the many things that we very much pride ourselves in terms of being best in class, highest caliber service provider. Real estate. So private equity, real estate, and then by extension, VC. So any sort of venture capital. I would say for this specific service, things like RICs, mutual funds, hedge funds, we're just not there yet, right? We want to be very niche. We want to be very, very focused. So private equity, real estate, VC, I think in terms of size and scale of clients, that'll evolve over time. Right now, what we're looking for is if there's two types of clients, there's one that says, yes, I agree. The administration service has gotten a little bit functionalized, a little bit commoditized, not fully, right? But there's enough of a commodity there, functional, where it's like, if that's all you need and that's all you want, there's some great service providers providers out there, right? But that's not the value that we're hoping to bring. What we're hoping to bring is to say, if you want more than that, if you want somebody who has that holistic approach, maybe you're an emerging private equity advisor launching your first fund. That's a prime example of a great client for us, right? We can help you navigate launching that management company. We have an FAO practice, right? They've been doing this for a long time, helping operate the back office of the management company. By extension, you launch the fund. Great. We've got a fund services team that can help you. You've made your first investment. Great. Let us, consult you with our valuation group. Oh, you need due diligence, right? So, and of course, tax, sort of overarching all this. So an emerging manager that's going through that in the private equity real estate space, we like to say, hire your portfolio team, hire your legal counsel, right? I'm sure there's a few others, but everything else you can get to RSM.
And are you going to do that work in the PE and also the portfolio level also below the fund?
Yeah. Thank you for mentioning that, actually. So within that ecosystem, so management company, then the fund gets launched, then they start making those investments. So whether it's ESG, or valuation, or it's back office operations, again, our FAO team, right? We can really be your service provider. And what we've built, and again, this is why I think we're very focused on clients that want that holistic solution, is that integration that flows across those layers. The number of times we talk to clients and they say, well, I've got these intercompanies between my management company and my fund, or I've got these issues between the portco level and the fund level. That's the solution we built, not just fund services, but a solution that flows up and down here across the ecosystem. Yeah,
well, listen, as you know, we know that part of the world pretty well, and it's certainly not consolidating, right? And yet, one of the things I do at the end of this, after you guys go, is I talk monthly a little bit about kind of the league tables, right? And one of the things that's really interesting with admins, and I'd say this has been a trend for, I'd say a good year now, is, one of the things I'm going to quickly talk about later is, year over year, so March to March, 22 to 23, assets in fund admin went down about 1%, right? Admins 1 through 5 went down about 3%. Admins 6 plus averaged close to 10% growth. So the market is moving business down market. We're seeing a lot of shifting of business beyond and you see the same thing in the audit, right? For five on, right? That growth is coming down market. And I think people are feeling that pricing models might be better, service levels might be better, and some of that nimbleness exists, right? With certain industries. But it's an exciting time to be doing what you're doing. I think there's a great need for it. I think you guys are very smart. Closed end is where all the growth is. Even though I think last year hedge fund assets grew 10 or 11 or 12%, most of that money was in existing funds, right? So all the new funds were closed end funds, right? I mean, I think we spent you guys, we do a capital flows forecast out 3 years, and the closed end growth is, we're super bullish on it, right? And it continues. Yeah. So I think your timing is great. One last question. And it's kind of the obvious question that I'm sure you've answered 100 times, but I'm going to ask for our audience. And there's plenty of precedent for it, so I understand it. But hey, isn't there a conflict of interest with an assurance practice opening up a fund admin? Talk.
Yes. We've gotten our PhDs in independence in the last few years as we've navigated this, and it's not overly unique to fund services. This is a broader challenge that every public accounting firm has to navigate, and I think they're doing it well. Right, we'll always have challenges, but us and our peers are there's a lot of us that offer consulting and audit, and this is just another consulting service that sort of begs the question: do you have the right sort of ecosystem design, right? Controls, policy, procedures. What I would tell you is this is one of the things that we're very focused on is we said, because we can't do both in some cases, we certainly can't be your fund auditor and your fund administrator, right? Now we can be your fund administrator and help out at the portco level, subject to certain AICPA rules. If you're taking those portcos public, sure, that's SEC. If we're the auditor, no, there's a conflict there. But before we even get there, right, it was about having a dialogue up front. And what Brian, John, myself, and the rest of the team really had a good conversation about a while back was we need to do a better job of giving our clients the choice. How do you want RSM to serve you, right? We can serve you as a private equity auditor, as a private equity consultant. And based on that, we're looking much more further downstream to say, tell us about the portfolio you're going to build or the portfolio you already have. What are your intentions, right? IPO, what's your exit strategy? And I know that things change, right? Things change overnight, those types of things. But having the right dialogue up front and then monitoring it, right? We're very carefully monitoring it month to month, quarter to quarter to make sure we understand where those instances happen. But really, it was about an upstream. Let's have the dialogue up front. Let's understand how they want us to serve them, and then let's serve them that way.
Yeah. No, it's good. It's interesting because it does come up, and there's plenty of precedent for it out there, right? And
Right.
All right, moving along. Brian, I want to come back to you. I think very relevant is the rule on vendor selection, right? And to everybody on this call, right? So I'd love to hear you kind of do a little deeper dive on, your guys' views on that and some of the, some of what that presents to people in the marketplace this year.
Sure, George. So the SEC's rule is really going to require, starting with selection, but almost a cradle to grave type of program of management and oversight over vendors. This whole topic of third party or vendor management really gained a lot of prominence around the time of the mortgage crisis. And the banking regulators, as part of the fallout from that, really focused on it quite a bit. So we've been working with clients in the banking space and other industries for some time. So when the SEC rule came out, obviously one of the first things we do, almost an academic exercise, is compare and contrast what's out there. I don't think, all the regulators got together after work and went out for a beer and decided they would do the same thing, because the SEC has a lot of unique aspects to it. They've really, almost defined what they think are critical services. They call them covered services that they want included in the program. I think I know Convergence works with some other organizations, and I took advantage of watching the episode you had with Schulte to get the rule perspective. And as much time as I spent with the rule, I took a lot of notes and learned a lot. I think our perspective is more from folks who have rolled up our sleeves and helped, start programs kind of from a nuts and bolts. And I think, some of the challenges that RIA's investment advisors are going to have is one, it's going to be very difficult to do this without some kind of underlying supporting technology. We used to have rules of thumb that said, well, maybe with 100 vendors, below that, you could maybe do it, somewhat manually. I think because of the requirements for documentation and proving, to the regulator, I think that level goes way down. I think it's going to be near impossible to do this. The good news is there's about 30 providers of software out there now, very crowded space.
Yeah.
All kinds of price points. But it is a little bit crowded, a little difficult, to navigate if you haven't been in there. I think investment advisors are going to find out who their friends are, in terms of dealing with their service providers. You're going to have some that will push back. They don't want to be involved. Thinking you've hired us or are going to hire us. It's all part of the package. Some they'll need to drag in, and some will embrace it. They'll see, this is part of the new dynamic. In terms of outsourcing, you're only as good as your weakest service provider in many cases. And investment advisors are going to need to see that and engage at a level with service provider they haven't before.
Yeah. What's interesting, Brian and John and Bill, is, I've heard the conspiracy theory, right, about this can promote great consolidation, right? Because there's, 600 plus admins and 500 plus auditors and 1,400 custodians and 300 prime brokers, right? And everybody can't be best fit, right? So there's that school of thought that there could be some consolidation. I personally think, and I'd be interested in your guys' thoughts on this. I think it's going to be very challenging for the small providers, some of this. I secondly think it may be hard for certain service providers to pivot into other services and products the way they maybe want to strategically, because the demand may get, curtailed a bit for something like this. And an example might be, say you were an administrator who was hedge fund only, 99% hedge funds you're servicing. And all of a sudden in your master plan, you wanted to go, I want to start doing closed end, right? I want to start doing PE and VC. Well, one of the things, we provide people is something we call best fit. Well, hey, if you're going to go do business with that PE fund admin, here's their PE book today. And you know what? It's 35% of their book, or it's 1% of their book, right? And maybe that's not a good choice if that's not something they really do. So I think it's going to be, I think it's going to hurt the smaller providers, right? And I think it's going to be challenging for people who want to bring in a different kind of business than they're doing today. Just interested in your guys' reaction to that. Fire away, Bill. Start with you.
Yeah. So I didn't want to speak. So I guess in no particular order, yes to everything you said. In terms of the perception, I think it's a shared one. I mean, where do I start, right? I mean, this is fundamentally where the challenge becomes the number of vendors you're dealing with, right? Just starting there. If the hub and spoke, right? If you have 12 different vendors of different size and scale, from startup shops to the highly seasoned, veterans, if you may, of the business, that can be challenging, right? So asking, how many vendors do I work with, why, right, et cetera. I mean, that's certainly one of them. I do think it's going to be challenging. I think it's going to challenge. It is going to stress test a little bit in terms of, who the players are, today and call it a year or 2 years from now. So it'll be interesting to see how that sort of falls out. But yeah, I think just going back to the point earlier, just it calls into question, how many vendors do you work with, to what extent, and to Brian's point, right? Hopefully they're willing to be highly collaborative, and they're willing to be, a good consultant or provider or vendor and provide you what you need, and they are providing you what you need. And if not, then begs the question, right? Is it the right fit for us?
And some of it's going to change. In some cases, the way maybe business has just always been done, right? Like I think about custodians, right? You take in a separately managed account, maybe as an asset manager. You kind of take the custodian of the assets maybe and add them to your list of custodians, right? And now you got 18 custodians because of your separately managed account business, right? So it's going to be interesting. Brian, any final thoughts on the SEC rule before we move on?
I think you're right. I think there'll be some consolidation. There'll be some realignment. It's going to cause certainly some advisors to rethink their entire vendor strategy. Yep. Right? It may have evolved, may take a step back and say, how do we want to do this going forward? So it will certainly generate a lot of conversation.
Yeah, and like for guys like us, it should be very opportunistic, right? It should be lots of opportunity for a good firm out there, right? All right, I don't want to spend too much time on this as we wrap up, but I'd be remiss not to bring up this whole banking thing. Whether it be SVB or Signature Bank or Credit Suisse or just basic asset liability risk management. We can go anywhere you want to go, but just curious on your guys' views and comments on that over the last 2 weeks. It's certainly preoccupied most of us.
Yeah, George, I'll take that. And I think it certainly has. It's occupied, to be honest, our clients, our people, even my kids were asking, "Hey, Dad, do we need to take money out of the bank?" Which is kind of scary that my younger sons are asking that question. But I think it's a lack of confidence in that the transparency that customers that have had with their assets and where they can get it and how quickly they can move things. But I think when we look at it, we've published a number of things in the last couple of weeks just to keep people up to date where things are at. Is kind of knowing your business. It's a little bit back to basics, right?
Yeah.
People got a lot of if you look at SVP, for example, a lot of deposits that were in excess of the FDIC limit, and people I think will probably take a renewed focus on spreading their assets out, making sure that kind of gets diversified from that portfolio, and really know your customer, know your business, and where it's at. Our client business was impacted by it, not only our financial services or asset management practice, but a lot of what we call our TMT or our technology practice dealt a lot with clients in the Bay that were heavily impacted by SVB, our digital asset clients that were impacted by Signature, and certainly Credit Suisse is something that portrays worldwide. So I think we've just been trying to be in front with our clients. They've gotten around it pretty quickly.
Yeah.
And obviously, a lot of things are still in play with the Fed potentially raising rates and still this kind of lack of confidence in the markets. I think you're going to still see some volatility for the
I mean, listen, this is if you're a hedge fund bullish on the bank market, this is a great time to get in, right? And because I'm watching bank stocks every day. But I was last point I'll make is I was very impressed by how I think our industry came together on this in terms of data and data sharing and helping each other with client exposure and SVB is even a client of Convergence, and they could not have been better to work with in terms of at a pretty rough time. But yeah, I think there's still the sabers rattling out there a little bit still. I think more to your point, John. I think probably in the last week, more people learned more about, FDIC and SPIC insurance, right? Than they ever knew, right? So, all right. Some closing comments, John, just on today's session. I really enjoyed it. I think we covered a lot quickly, but anything you want to kind of leave our audience with today?
No, George, thank you again for the opportunity to present. On behalf of Brian and Bill, we really love the appreciation we have and the collaboration we have with your firm. You obviously have been out there front and center with the marketplace, the issues that are kind of going on, as are we, just trying to get out. What we're doing isn't rocket science, but we're truly taking care of clients, taking care of the business, and being proactive as to what we not only are seeing today, but what we're seeing tomorrow.
Yeah.
So again, I want to thank you for the platform, the opportunity to discuss, and look forward to our future and continued collaboration.
Yeah, no, listen, you guys have been a great client, and we've enjoyed very much watching, kind of you strategically grow the way you have, and we'd like to think we're helpful in that. But I enjoyed our conversation today, everybody, and really thank you. And we'll see you for I don't know within the next year for another episode. So, all right. So thank you all. All right. I want to thank RSM, John, Brian, and Bill. Really a terrific organization and a terrific conversation. As always, I just kind of finished up for a minute or two with a quick look at service provider growth. And I must tell you, this trend is continuing that we're going to talk about today. So when I look from March of 22 to March 23, we saw fund administrator assets decrease about 1%. Interestingly enough, when you look at the distribution of that, the top 5 admins shrunk about 3.3%. Admins 6 to 10 went up about 8%, and admins 11 to 25 went up about a little over 10%. So clearly seeing the solid growth at a time when assets are going down in admins kind of 6 to 25. On the audit front, almost the same story, but almost much more amplified, right? Assets down that 1%, at the big 4 down about 2%, but auditors 5 to 10 actually grew 61%, which is really phenomenal. And auditors 11 to 25 grew at 15%. And so think of those numbers, 61% and 15% in a market that went down 1%. On the prime front, we look at funds, right? So funds grew about 12.7%, and the top 10 PBs grew about 2%, and PBs 11 to 25 grew at about 4.5%, and then all other primes grew at about 10%. So seeing kind of that down market activity pretty much. And then lastly, with custodians, custody assets up about 7%, 1 to 10 up 3%, 11 to 25 up about 9%, and then all others 26 plus up about 21%. So really, when you look at all the markets, right, we're just continue to see this down market push. So I want to thank you. Episode 25, I thought we had a great conversation with RSM. I want to thank you all for joining us, and we will see you next month. Thanks.